What's up, Internet? It is your boy, Eric Bandholz, back again with Beardbrand. Hope you are doing well on the other side of the Internet. Wanted to come back to you again with one of my widely popular tips on how to become more personally free. So in this episode, I wanted to talk about the financial aspect of freedom and maybe dig down into a little more details of the financial aspect and give you a little more insight, a little more tools to help you become personally free. So my first bullet point, and really probably the biggest change with finance or your money, is debt. So debt is something that can be very valuable, but it can also be something that can destroy your life and really put handcuffs and chains around your ankles. So think of debt as a tool. What you're doing is you're getting access to money in the current time frame with the hopes to pay it back over time. So what you're doing is you're paying someone the ability to give you all this money at once, and then you'll pay them back over time as you can afford to pay it. So it's great for investment type of activities where the money you're bringing in you can use to make more money than you're paying back. So an investment would be start off with like a student loan to an appropriate school or education. But beyond that, if you're investing into, your home isn't really an investment, but it kind of is when you compare it to the alternative of renting. But you shouldn't really consider it an investment. I'm thinking of investing in maybe your business or investing in something that improves your life. Now, you don't want to use debt to satisfy a want or desire. So you don't want to say, well, I've got a car that I know works, it's paid off, but I just really like that new car out there. It's pretty. It's not really going to improve my life. It's not going to help me get to work any faster. It's not going to help me do X, Y, Z. But I want it. It's cool. So using debt to buy a car like that is a bad case. But the alternative is where buying a car and using debt might be a good thing is say, hey, I currently don't have a car. There's a job opportunity that pays me $20,000 more a year, but I need a car to get to it. So going into debt to buy that car is a good investment because it's going to help you find a job that you want. So again, with the key to the debt, find out if you are going into debt or you're acquiring this debt as a way to invest in yourself, or is it a way to satisfy a desire or a need? So if it's the latter, try to avoid debt. If it's the former, definitely make sure that it makes sense from an investment perspective, but it's going to be a more wise decision than the alternative. I kind of talked about this. Always invest in yourself. Always educate. And investment can be free. It could be you watching videos on YouTube on how to learn to be a graphic designer. I'm self-taught in graphic design. I've never taken a class on it. And maybe some days it shows and some days it doesn't. But as I work on it, as I improve, I'm building skills and assets that I can use down the road. And these tools is going to help your finances down the road because you're going to make yourself more valuable. And when you're more valuable, you can charge more money for your time or for your services. Wanted to get down into, we talked about investing in yourself, but also talk about investments in general. So there's really three main camps of investments out there that I like to break it up. You've got your paper assets, which are going to be your stocks and your bonds. You're going to have your real assets, which are going to be property, land, and precious metals, gold, silver. And then cash is going to be your third investment. So one of the biggest things that I would recommend is to diversify your assets. So investments are a tool to help you preserve wealth and to grow wealth. They're not necessarily a tool to generate income for yourself. So when you think of it that way, if you want to protect your wealth against the threats of inflation, against the threat of, well, just losing it, you know, and not having it. You want to have a good savings for the future. You'll want to diversify that because there are threats in all these. So the paper assets, the real assets, the cash, they all have threats. So for instance, cash has a very high threat against inflation, but it also has very liquid capabilities. So you have cash, you can exchange it for anything at any time, any point. So if you got $10,000 in cash, you want to buy a fridge, pull out the cash, you got the fridge. Boom, done. When you talk about paper assets, they're pretty liquid, but they're not as liquid as cash. So if you've got $10,000 in XYZ stock, well, you gotta sell the stock, wait for the stock to trade, transfer the funds to your bank account, and then boom, you've got your money to buy your fridge. And then your real assets are generally going to be even slower to convert into tradable assets. So if you buy land or if you buy properties and you want to get your money out of it to buy other things, then geez, it could take months up to years to be able to sell your properties for a fair value and get what you put into it, or get what you put into it and press the appreciation of the value. So those are the varying risks in terms of liquidity, but you also have risk beyond that. With paper investments, when you're buying a company on the stock exchange, there's a chance for the performance to go up or down. So within paper assets, you're going to want to diversify within that. So you're going to want to buy large companies, small companies. You're going to want to buy international companies. You're going to want to buy domestic companies. I personally, now don't take advice from me. I'm just some guy on the internet. Talk with someone who knows more. I used to work at Merrill Lynch, but I don't work there anymore. So take all this with a grain of salt. I'm a big fan of ETFs. And what ETFs do is it matches an index. So it matches a way of investing. And it does it automatically so that the costs are very low. So it's a type of mutual fund in a sense that gives you more liquidity than a mutual fund, equal diversification of a mutual fund, but lower cost of management because you're not having people pick the funds for you. It's done based on a preset determined ratio, like, you know, companies that make over $1 billion. This is XYZ fund. Or gold. You know, you can buy a gold ETF, GLD, or IAU, and it'll just diversify the gold. It'll hold the gold for you, so it gives you a little more liquidity without the maintenance cost of holding gold on you in real life. But there's also risk to this. You've seen stock market crashes. You've seen trading issues with NASDAQ and the New York Stock Exchange, and just the variety of trading platforms where, because so many of these are handled by computers, that there is a threat that they could just skyrocket or crash in a minute's notice. And generally, there's a 3-day trading cycle to correct any type of errors in the past, but there are ways that you could get screwed in it, conceivably. Real assets, you do, you'll get a lot of people out there who say you gotta just buy silver and gold and just stock up on gold, and there's risk to those as well. In addition to the risk of the demand going up and down like any other commodity, there is the risk that if you hold it on you, someone breaks into your house and steals your stuff, or there's a risk that your house burns down and your stuff gets destroyed. So and then there's the carrying cost. If you don't want to keep it on you and you store it at a bank, then you may have the safety of the bank, but there's also the risk that the bank could compensate your assets, or you forget about it and you don't tell your kids. Whatever it is, there's risk to any asset out there. So the proper way to protect against risk is by diversifying. So I like to have real assets, I like to have paper assets, and I like to have cash on me. And when I have these well diversified globally, then my risk of losing that wealth, you know, if the paper investments go down and just completely collapse, then I have my real assets. If my real assets totally tank, then I have my paper assets to fall back on. If my cash, you know, totally inflates, I've got the ability to pull from my cash and all that. So anyways, it's a little long-winded, kind of rambled there on the end, but hopefully that gives you a little more in-depth detail of what you should be doing with your assets and how you should be investing and how you should be spending your money so that you have these investments. Now, I'm 32 years old right now, and I've been investing since I was 15 or 16, and I don't have enough money where I don't have to work at all, and that's why I'm doing these videos. But the goal is to put a piece of my asset away so that in the future I'll be able to travel. So it's coming along. The final thing that I would recommend is you need to create a personal budget and really get a fine detail of how your money's coming in and how your money's going out, where you're losing money, where you're able to save money, where you're able to cut expenses, and then just kind of where your assets are. I've created my own personal Excel sheet, so I think I'll upload a link to that on our website, something. Maybe you can download it, put in your own information, and you'll have to tweak it because my expenses are a little bit different than everyone else's expenses. But you can kind of get a feel for the things that you should be keeping an eye on and keeping an eye on your cash flow. As always, hope this was valuable. I hope I helped improve your life. I hope I helped improve your financial situation. Thanks for watching. Thanks for subscribing. We'll have more in the future on this topic. Cheers and beard on.